Okay, welcome back to the deep dive.
Good to be here.
So today we're jumping straight in, right? We're looking at Niva Bupa health insurance.
That's right. Specifically, their Q2 and the half-year results for FY26.
And we've got the earnings call presentation from November 3rd, 2025, press releases, the filings, the whole package,
Yeah,
basically.
exactly. And our mission here really is to just cut through it all for you, give you the quick but deep understanding of where they stand.
Yeah, decoding the performance, the key metrics.
Yeah, like profitability, especially that IFRS versus IGAP thing, which is pretty crucial here. And also their strategy, products, distribution shifts.
Right. And let's maybe just get the big news out first. The headline finding.
Let's do it.
Their profit after tax, the PAPRIATA, under the newer IFRS accounting rules, it actually more than doubled in the second quarter compared to last year.
Doubled. Yeah, that's a massive growth signal right there.
Okay, so let's unpack that. But first, to really get that jump, we need to understand the context, the environment they were operating in.
Absolutely. Yeah. So H1 FY26 in India, the economy was, well, it was seeing sustained growth. Private consumption was strong, investment too.
And for insurance specifically, a pretty big change happened.
Oh, huge. The elimination of GST on retail health, personal accident, and travel insurance.
That's got to make a difference, right? Suddenly these products are just cheaper, more affordable.
Exactly. It creates a powerful tailwind, and Niva Bupa definitely caught that win.
So how does that show up in the numbers, like gross written premium, GWP?
Okay, so GWP, if we strip out some technical adjustments, it hit 3,983 crore for that first half, H1 FY26.
And growth-wise?
Up 22.9% compared to the year before. Pretty solid.
And the core, retail health.
Even faster. That part grew 27.6% in H1, hitting about 2,810 crore.
Which brings us back to profit, that doubled IFRS PAT figure.
Right. For the full half year, H1, the IFRS profit after tax landed at under 31.7 crore.
Up from what, about 60 crore last year?
Just under, 59.5 crore in H1 FY25. So a really significant jump under IFRS.
But, and this is where it gets tricky, isn't it? The IGAP number tells a very different story.
Completely different. This is really key for you to grasp. Under the older Indian standard, IGAP, they actually reported a loss.
A loss? How much?
A loss of 126.7 crore for H1 FY 2026.
Wow. Okay, wait. IFRS profit rockets up, IGAP shows a loss. That's a huge swing. What's driving that? Nearly 260 crore difference.
It's almost entirely down to the shift to IFRS 17. That's the new global accounting standard for insurance contracts.
And how does that change things so drastically?
Well, think of it like this. IFRS 17 lets insurers recognize the profit they expect to make from a policy over its entire lifetime, much earlier. It's not like the old IGAP rules where you waited longer.
So they're booking anticipated future profits now?
In a way, yes. For this half year, that specific adjustment, the insurance contracts bit under IFRS 17 added a positive 304.9 crore. That's what flips the result.
Okay, so the IFRS number looks great because it reflects future expected health of the business.
Right. It suggests the policies they're writing are expected to be profitable long-term under these global rules.
But the IGAP loss is more like a current cash reality under the old system.
Sort of. It's a reminder that the traditional view is still adjusting. You really need to look at both. IFRS for the strategic direction, IGAP for the, let's say, historical cash flow context during this transition.
It sounds like you need to be careful not to just take the IFRS number at face value without understanding that massive adjustment.
Exactly. You track IFRS for the future view, but understand the accounting shift causes this volatility. But importantly, whichever standard you look at, their financial base is strong.
How so?
The solvency ratio. It actually improved to 2.85 times. That's way above the minimum requirement. So financially stable.
Okay, stable base. Let's move on from the big financials. Is that profit translating into better operations? Are they running more efficiently?
Yeah, it looks like it. We're seeing improvements in efficiency metrics, which suggests they are managing costs well.
Like what specifically?
Let's take the combined insurance service ratio, CISR, under IFRS. This basically tells you how much premium goes out for claims and running the business.
Lower is better.
Always. And it improved. It went down to 103.1% in H1 FY26 from 104.2% the year before. So they're keeping a bit more margin.
And just pure operating costs, the expense ratio.
That dropped too, down to 37.2% in H1 from 39.5%. So yes, they seem to be getting leaner.
Okay, leaner operations. But the most visible part for customers is claims. How are they doing there? Can you be efficient and pay claims quickly and fairly?
Well, the numbers suggest yes, quite dramatically, actually. Look at the claims settlement ratio, the CSR.
How'd that look in Q2?
It hit 95.2% in Q2 FY26.
95.2. That sounds high. How does it compare?
It's a big jump, up 377 basis points from the same quarter last year. That's a sharp improvement. For the half year, it was 94.6%.
And does that speed and settlement rate make customers happier? Do we see that anywhere?
We do. It seems to feed into their customer advocacy scores, the weighted episodal net promoter score, NPS.
Right, the NPS score.
It was 57 for the half year. That's up 2 points from the full prior fiscal year. So customers seem more satisfied.
Okay, so happy customers, tighter expenses, looks good. Although one ratio went slightly up, the incurred claims ratio.
Yes, slightly. It went up to 65.9%. That measures the claims paid out against the premiums earned in the period. So while they're settling claims well, the actual cost of those claims relative to premiums edged up a little.
Which points towards the challenge of managing the cost of claims, right?
Exactly. And that brings us neatly into their core strategy.
Right, let's pivot then. Away from just the operational numbers to the strategic choices they're making. It sounds like there's a deliberate push somewhere.
Oh, very deliberate. Towards the high-value end of the market. And it's spearheaded by a big product launch. Reassure 3.0.
Reassure 3.0, what's the big deal with that?
They're really marketing it aggressively, calling it India's first truly unlimited health insurance plan.
Unlimited. What does that mean in practice?
2 key things stand out. First, an unlimited sum insured is available across all its versions. That's quite something.
Unlimited cover. Okay, and the second thing?
For the higher-end version, aimed at high-net-worth individuals, it includes what they call boardless treatment.
Boardless, so international cover.
Yes, anywhere in the world, with coverage up to 5 crore rupees. This is clearly a premium product chasing customers willing to pay significantly more for that peace of mind.
And this links back to the overall strategy, doesn't it? This isn't just one fancy product. It reflects a bigger shift.
Absolutely. It's fascinating, actually. They are consciously shifting their portfolio, their risk book, towards these high-sum insured policies.
Do we have data on that?
We do, and it's stark. Look at the new retail health policies they sold. The proportion of gross written premium coming from policies with a sum insured of 1 million or more.
So 10 lakh rupees and up.
Right. That chunk jumped from 74.1% of new business GWP in H1 last year to 83.8% in H1 this year.
Wow, 83.8%. That's a huge slice of new business coming from big policies. They're really going after that higher end.
It's a clear strategic choice. Trading potentially more numerous, smaller policies for fewer, larger, presumably stickier risks.
What does that imply about their underwriting, their confidence in pricing risk for these higher value customers?
It suggests they believe they can manage it, that maybe the loyalty is higher, the margins are better, perhaps the frequency of claims is lower, even if the severity, when a claim happens, is higher.
And how are they reaching these customers? Is the distribution changing?
It's still pretty diversified. In Q2, individual agents brought in 31% of GWP, brokers 27%, bancassurance banks 20%, and direct sales about 10%.
Any channel growing particularly fast?
Yes, one stood out in Q2, corporate agents but not banks. That channel grew 44% year over year.
Interesting. So maybe specific partnerships there targeting employee groups or customer bases.
Could be. It suggests a focused effort there. And despite this strategic shift towards higher value, their overall retail health market share held steady. 9.9% in H1. So they're maintaining their footprint while reshaping the kind of customer they attract.
Okay, managing this growing, increasingly high-value base must require some serious tech infrastructure.
Definitely. And the digital adoption numbers are, frankly, quite impressive. They're clearly using automation to manage scale and cost.
Give us some examples.
Okay, get this. 99.9% of new policies were applied for digitally website, mobile apps.
Almost everything. And claims. That's often the messy part.
Still very high digital submission. 91.6% of claims came in digitally.
That level of digital intake must be a key enabler for that faster claim settlement ratio we talked about earlier.
Has to be. It streamlines the whole process.
Yeah.
And it also helps them tackle that other big challenge, claims cost.
Right, the cost side. How are they managing that specifically?
A big part of it is their preferred partner network, the PPN hospitals. They've been expanding it.
How big is it now?
Up to 855 PPN hospitals across 44 cities.
And the strategy there is?
For Niva Bupa, it's about getting better deals, basically. Negotiating favorable discount packages with these hospitals to control the cost of treatment.
Which is critical because medical inflation isn't slowing down, is it?
Not at all. We mentioned the Retail Health Claims Cost Index earlier. It reflects that underlying medical cost inflation.
And the rate was.
It grew at a compound annual growth rate, a CAGR, of 7.0% between FY 2019 and this recent half-year, H1 FY26.
7% CAGR. That's a constant pressure pushing costs up every year.
It's a relentless headwind for the whole industry.
So how tough is that balancing act? Pushing for 95% claim settlement, keeping customers happy via NPS, while squeezing hospitals for discounts through the PPN to fight that 7% inflation.
That is the core strategic tension, isn't it? Service versus cost control. The PPN is their main lever on the cost side. They mentioned PPN claims make up about 19% of their claims cost in those PPN cities.
And they offer customers perks for using PPN hospitals too, right?
Yeah, things like free ambulance services, dedicated relationship managers, trying to make it attractive for the customer as well as cost-effective for the company.
Okay, almost there. Let's touch on one final important point. Something flagged by the auditors, the emphasis of matter note.
Yes, this is crucial, especially for anyone watching the regulatory side closely.
What did it say?
So the joint statutory auditors put this note in their review report. It points out that Niva Bupa actually exceeded the allowed limit for expenses of management, or EOM, back in FY 2024-25.
Exceeded the regulatory limit on how much they can spend on running the business.
Exactly. Things like overheads, commissions, admin costs. There's a cap set by the regulator, IRDAI.
And Niva Bupa went over it. What happens then?
They've applied to IRDAI for forbearance, which is basically asking for permission, sort of retroactive approval, but that approval is still pending.
So even though their expense ratio improved in this latest half year,
Right. The ratio looked better recently.
the auditors are highlighting this past issue, which is still unresolved with the regulator.
Precisely. It's not a material misstatement. It doesn't mean the current financials are wrong, but it's a yellow flag. It reminds us that insurers are under constant pressure from the regulator to be efficient, to keep those management expenses in check, arguably for the benefit of policyholders.
Even when they're posting strong IFRS profits, the regulatory scrutiny on efficiency is always there.
Always. It's a key feature of the Indian insurance market.
Okay, let's try and wrap this up. Key takeaways then. First, that headline, IFRS profit after tax doubling in Q2. Huge number.
Driven largely by strong retail GWP growth, helped by that GST removal.
Second, the clear strategic pivot, launching innovative products like Reassure 3.0.
And really shifting the new business heavily towards those high sum insured policies, 83.8% of new GWP now.
And third, operationally, getting sharper, especially on claims with that CSR hitting 95.2% in Q2.
And improving efficiency ratios overall.
So the final thought then, what's the big question this leaves us with?
Well, you put it all together, right? You've got this successful shift to high-value customers, which they're showing off using the new IFRS accounting to highlight future profit now.
While at the same time,
While at the same time, they're battling that constant 7% underlying medical inflation. So the big question, I think, is this. Can that growth and the profitability they're embedding in these larger policies, combined with their risk controls like the PPN network, can that combination consistently outpace the rising cost of healthcare?
especially with the regulator breathing down their neck on efficiency, like that EOM limit issue highlights?
Exactly. Will the strategy be enough to stay ahead of inflation and regulatory pressure long term? That's the structural challenge. That's really something for you to think about as you watch how Niva Bupa performs next.
Indeed. Lot to mull over there. Go forth and keep digging into how the financials and the strategy really connect. We'll see you on the next deep dive.